Hi, Professor Barati here. I'd like to go over problem 1639 with you. 1639 is essentially another variance analysis problem. It builds on variance analysis techniques from prior chapters. Essentially, the reason why we do this type of analysis, a sales volume, sales quantity, and sales mix analysis variance, is because what we do is we try to explain why our actuals are different from our budget, why we're either favorable or unfavorable to our budget. But this time we look at the sales mix. So most companies don't sell one product. They sell many products. And so depending on different product mixes, most products have different contribution margins or different gross profit margins. So if a company sells for a particular month a high-priced product over more than it budgeted for, it most likely will see higher profits in the form of gross profit or contribution margin for that month. So essentially, what this problem tries to teach us is it tries to teach us how to analyze how shifts in sales mix affects our contribution margin or gross profit margins. So let's read the problem. The Greensboro Performing Arts has a total of 9,000 seats. 2,600 seats are center seats, 3,100 seats are side seats, and 3,300 are balcony seats. The budgeted and actual tickets sold for a Broadway musical show are as follows. For the center seats, the ticket price is $115. The side seats are $105. The balcony seats are $95. The budgeted for center, we basically budgeted 80% of the seats capacity for center, so it would be 80% of 2,600. For the side, we budgeted 70% capacity of the 3,100 seats. And the balcony has a capacity of 3,300 seats, and we budgeted 75% of that. On the actual seats, we basically sold 85% of the capacity of center seats, 75% of side seats, and 65% of balcony seats. So as you can see, we have our budgeted seats based on a percent of capacity, and the actual seats that sold for that period based on a percentage of capacity. So in this case, we actually sold more seats than budgeted for the higher ticket price, which should help us have a favorable variance. We sold more seats than budgeted for the side balcony, or the side seats, at $105, which should give us a favorable variance. We sold 65% versus 75% of the balcony seats, which are the lower ticket price seats, which will be an unfavorable variance. However, the impact of all of these combined is what we're looking to see whether we end up with a favorable or unfavorable variance. Again, like every variance we have to analyze, we're going to have to break that variance into two components, either price or quantity/efficiency variance if it's input related, or if we're looking at comparing to a budget, a high-level income statement, which is what we're doing here, we're going to have a flexible variance of some sort, and which they call sales mix in this problem, and a quantity variance, which is also in this problem. To tell us the actual ticket prices are the same as those budgeted. So the ticket prices are the same as budgeted, and therefore we really won't have to worry about pricing variances. So this is how you approach this problem. We have our products, center, side, and balcony. You could call these any products you want, really doesn't matter. And what we have here is a budget. We're going to take a budgeted ticket, $115, $105, and $95. Now, the problem tells us compute the following: the budgeted and actual sales mix for different types of seats, and the budgeted average contribution margin per seat. Assume the ticket price is also the contribution margin. So it's a very important factor here. The ticket price is the same as the contribution margin. Normally, in most problems, you would have to come up with a budgeted sales price minus a budgeted variable cost to get to a budgeted contribution margin. In this case, they're telling us the contribution margin is the same as the ticket price. Not the best test here or the best question, but let's just say that for now, the contribution, as the problem says, is the same as the ticket price. Now, they tell us the budgeted quantities, we're going to have to take the capacity here. So, total capacity is 9,000 seats. We had 2,600 seats for center, 3,100 side seats, and 3,300 balcony. In this case, we have 80% of the budgeted seats budgeted. So we're going to take 80% of 2,600 as our quantity. For our side seats, we're going to take 70% of 3,100. And for the balcony, on a budget side, we're going to take 75% of 3,300. So, basically number of seats total is, all three added up, 6,725 seats in total. So the problem wants to know is what budget and actual sales mix percentages for different types of seats. So this is simply a weighted average problem here. So the percents, basically 2,080 divided by the total, and we'll hold that cell. We'll do the same. And hopefully this adds up to 100%. And this is basically our sales mix. Again, this is the all budget. This is all budget information. From there, we're going to do this. We're going to calculate the contribution margin per sales ticket times the number of tickets sold for this segment and come up with a budgeted contribution margin. So we're going to call this budgeted contribution margin, which is going to equal budgeted contribution margin times tickets. So we're going to take a contribution margin per ticket for the center seats times the number of center seats that we budgeted to sell. And that's our total contribution margin in dollars. And the total is $702,175 of budgeted contribution margin. So this is basically what we do on the budget side. On the actual side, again, we're going to do the total tickets actually sold for the period based on the information they gave us. So we're going to take 85% of 2,600. $75 of 3,100. And 65% of 3,300. And these are the total tickets that were sold. 6,680 tickets sold. As you can see, the total tickets sold were slightly less than what was budgeted. Okay, so we might have an unfavorable contribution margin variance here. However, we sold more of the higher price tickets. 2,210 versus 2,080. We sold 2,325 tickets of the side seats versus 2,170 budgeted, and that has a higher contribution margin. But we sold considerably less balcony, but that was the lower one. So this entire mix basically impacts our contribution margin, and we're going to try to explain how that impacts it. The next thing you want to do is simply take the budgeted contribution margin times actual quantity. And this is basically a flexible budget. You're taking the budgeted contribution margin times the actual quantity. That's basically the definition of a flexible budget. Taking the budget prices and costs at the actual volume or actual activity. So we're going to take the budgeted contribution margin times actuals, and do that across. Now, we're going to take these sales mix percents as well, because the problem asks us to solve that. So this is going to equal the actual divided by the total. And again, let's make sure that it equals 100%. Okay, so these basically are your budgeted sales mix. 30.93, 32.26, and 36.8 on the budget side, which is what we have. And on the actual side, 33.8. Oh wait, I'm sorry, 34.81 is rounding here, and 32.1. So basically, that's how you would do question 1. Now, basically, the sales activity variance, or sometimes it might be called sales quantity variance, is going to be simply the difference between the budgeted contribution margin at budgeted price times the budgeted contribution margin at actual price. So because this is actual oriented, if the actual is higher than the budget on a contribution margin approach, we have a favorable variance, and I will basically put an F there for favorable. We have a favorable variance on the side seats, 244,000 versus 227,000, and we should have an unfavorable variance on the balcony. We'll put a sum here. So total variance is going to be $125 unfavorable, and basically the budget showed that we should have had for a contribution margin $702,175. We ended up with $702,050, a unfavorable variance of $125. But as you can see, what generated that $125 was not the center or the side seats. They had favorable variances. It was the balcony. So the sales mix variance must be calculated by taking the variance of each segment by itself. So let's work with the center first. We're going to do 3 columns like we did here. Again, this is the sales activity variance right here. The center was favorable, the side was favorable, the balcony was unfavorable. So let's look at the center and break down this $14,950. Behind this $14,950 favorable variance is a breakdown of a sales mix and a sales quantity. So the way to do that is simple. On the center, you want to take the flexible amount of $254,150. Or you could just simply take the budgeted contribution and multiply it by the actuals. So for center, I'm going to call this column flexible. Now, we're going to take straightforward the master budget, which is going to equal the 239. However, we have this middle part here now where we're going to calculate our variance. This middle section is sort of a flexible on the flexible. So what this is the following formula. You're going to take the budgeted contribution margin and multiply that by the actual quantity at sales mix percent. So in other words, you're going to take the budgeted contribution margin, which equals the 115 for the center, and you're going to multiply that by the actual quantity at the sales mix percent. The actual quantity of center tickets sold was $2,210. However, what this column basically does, it converts the actuals to the percent of the sales mix budgeted. So in other words, the actual quantity at budgeted sales mix percent equals 2210 times sales mix budget. So it's not the 2210, it's the total. We sold a total of 6,680 tickets times the budgeted percent. So what this column says is take the actual total tickets sold for all 3 and convert it. In other words, what should we have sold based on a budgeted sales mix? So we sold 6,680 tickets actual, but 30.93% should have been center based on budget. 32.27% should have been side based on budget. So we ignore the actual ratios here and we basically take the actual 6,680, which is this I-15, and we multiply it by the 30.93%. So now we're focusing on these 3 numbers. So the sales mix variance, is going to equal the flexible minus the budgeted contribution multiplied by the actual quantity based on the budgeted sales mix percent. As you can see, that's favorable. The sales quantity variance is going to be based on the budgeted contribution margin at actual quantity as if it were at budgeted sales mix percent minus the master budget. And that's unfavorable. Now, if you take the favorable sales mix variance and you add that to the sales quantity variance, our sales activity variance is simply adding the two. And as you can see, this 14,950 equals this 14,950. So the sales activity variance, which is simply the flexible budget of the ticket price at the actual number of seats sold, this $14,950 favorable variance is due to the fact that we have a sales mix, meaning we sold more actuals than we budgeted for the center tickets, which have a higher budget price. However, on the quantity side, we should have sold 2,066 tickets based on the budgeted sales mix of 30.93%. We were budgeted to sell 2,080. So, based on that flexible budget, we sold less. So on a quantity variance, we have an unfavorable variance. But when combined, we have the 14,950 favorable variance, which we got from here. So looking at our problem, the budgeted average contribution margin per seat, number 2, to derive that number is basically take the average budgeted contribution margin. So if you just simply take the 702 and divide it by 6725, you should get your answer. Total sales mix variance. So the total sales mix variance you're going to have to do that for each segment, what we did here. You're going to have to do the same for the side and the balcony. So 16,551 is basically this number here, 16,550 is rounded. Total sales quantity variance is the number we did here, 1,600.59, which they round to 1,601. And if you do that for all three, follow the same steps, you essentially get your answers. So you would simply do the same approach for all three. So essentially, that's how you approach a sales mix variance problem. I appreciate you listening and watching the video. Thank you.